Hello friends, I am Sankar Srinivasan, a certified market professional of National Stock Exchange of India. I am from Madurai city of Tamil Nadu state, India. I have more than 20 years of experience in stock market field. By launching this YouTube channel, I am providing expert advice and speeches on advanced trading topics. First topic is how to trade volatility. You everything know about volatility. In this video, I am talking about volatility. Topic is how to trade volatility. VIX, VIX, Vega, and options. Why volatility matters? In today's advanced session, we will dive into one of the most misunderstood but powerful areas in trading: volatility. Volatility is not your enemy. In fact, it is a trader's best friend when you know how to measure it, interpret it, and use it to your advantage. Today, I will teach you how to trade volatility by using VIX, VIX, the fear index, Vega, 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 the options Greek that reacts to volatility, and strategic options trades like Straddles, Strangles, and iron Condors. Whether you trade stocks, futures, crypto, or currencies, volatility is always in play. Let's begin. First one is, what is volatility? Volatility is the rate at which the price of an asset moves. When price moves fast, up or down, the market is said to be volatile. There are two types of volatility. One is historical volatility, how much the price moved in the past, that is historical volatility. Another one is implied volatility, IV, the market's expectation of how much it might move in the future. Volatility does not tell you direction, it only tells you that a big move is coming. That's why professional traders focus on volatility instead of just price. Understanding VIX, VIX, the fear coach. The VIX, that is called Volatility Index, measures the implied volatility of Nifty 50 options in India. In the US, it's the volatility of S&P 500 options. What does the VIX tell you? Low VIX, below 15, is calm markets. High VIX, above 20, is panic, uncertainty, or major event upcoming. Spikes in VIX, that is, hedge funds are buying protection. In other words, puts under or put option, expecting trouble. VIX often moves opposite to the stock market. When Nifty crashes, VIX rises. When Nifty is steady, VIX stays low. Once again I am telling, VIX often moves opposite to the stock market. When Nifty crashes, VIX rises. When Nifty is steady, VIX stays low. Hope you understand. Trading insight. High VIX equal to options are expensive. Low VIX equal to options are cheap. Once again, high VIX equal to options are expensive. Low VIX equal to options are cheap. This helps us decide when to buy or sell options. Hope you understand. If you have any doubts, post your doubts in comment section. Next topic is Vega, the Greek of volatility. I think you know about Vega. Alpha, beta, gamma, Vega. Option traders know about this. In options trading, Vega measures how much the price of an option will change if volatility changes. Once again, in option trading, Vega measures how much the price of an option will change if volatility changes. If Vega is 0.10 and IV increases by 1%, the option price increases by 10 paisa or 10 cents. Once again, if Vega is 0.10 and IV increases by 1%, the option price increases by 10 paisa or 10 cents. Why Vega matters? Options with more time to expiry have higher Vega. Options with more time to expiry have higher Vega. At the money options, once again, at the money options, ATM, at the money options are most sensitive to changes in volatility. Long Vega means your position benefits from increasing volatility. That is, in other words, buying option calls. Short Vega means you profit when volatility falls. Short Vega means you profit when volatility falls. That is selling options. Once again, long Vega means your position benefits from increasing volatility. In other words, buying options. Short Vega means you profit when volatility falls. In other words, selling options. Next chapter. Volatility based option strategies. Now let's talk about strategies. First one is long straddle. Long straddle. Buy a call and a put at the same strike price. Used when you expect a big move in either direction. I am talking about long straddle, buy a call and a put at the same strike price, used when you expect a big move in either direction. Ideal when VIX is low and you expect news or earnings. Second one is long strangle. Buy a call and a put at different strike prices, out of the money. No need to tell, out of the money. Buy a call and a put at different strike prices. Cheaper than a straddle but needs a bigger move to profit. This is good for uncertain political events and budget announcements or any financial announcements. Third one is short straddle. Sell a call and put at the same strike price. Sell a call and put at the same strike price. Profit from time decay and low volatility. Profit from time decay and low volatility. This is high risk if the market moves sharply. Fourth one is iron Condor. Iron Condor is sell a call and put spread above and below market. Sell a call and put spread above and below market. This is for limited risk, limited reward strategy. Best used when you expect the market to stay within a range. Hope you understand. Iron Condor is best used when you expect the market to stay within a range, not in a bigger move. Next chapter is real world trading examples. Let's now go through 3 real case studies. First example, Nifty budget day trade. VIX is 12, very low. You expect a big movement due to budget. You buy a straddle at 22,000, cost 2,500 rupees. Nifty moves 400 points up in up direction. Call option increases dramatically. Your straddle makes 3,000 rupees or 3,000 and something higher. Hope you understand. Once again I repeat. Nifty budget day trade. VIX is in 12, that is very low. You expect big movement due to budget. You buy a straddle at 22,000 rupees, cost 2,500 rupees. Nifty moves 400 points up direction. call option increases dramatically. Your straddle max 3000 rupees. You bought it 2500, it makes it reaches 3000, so you got profit 500 rupees per lot of call option. Another example, in cryptocurrency trade, at the time of a Bitcoin halving event, you know about halving? In halving, the miners know about the halving well. After getting the mining, a block is forming with some portion of Bitcoin as a reward. In the halving period, the reward is reduced by 50%. That is, if the reward is reducing, the Bitcoin value is getting stronger. That is a halving event. In that type of Bitcoin halving event, implied volatility is low before event. You buy a Strangle, 60k call or 55k put. Once again I repeat. In example 2, I am talking about Bitcoin halving event. In the halving event, implied volatility is low before event, before the halving event. You buy a Strangle, $60,000 call option, $55,000 put option. After the event, Bitcoin crashes to 52k. That is, after the event, after the halving event, Bitcoin crashes to $52,000. Put makes a big profit, offsetting call options loss. Hope you understand. Put option makes a big profit because price was reduced to $52,000. Put makes a big profit, offsetting call options loss. Another example is options seller in flat market. India VIX is 20, now drops to 12. You sell a Straddle at 22,000 rupees. Market stays within 100 points. Both options decay to near zero. Your pocket full premium. Hope you understand. Once again I repeat. India VIX is 20. Now drops to 12. That is, VIX was reduced. You sell a Straddle at 22,000 rupees. Market stays within 100 points. Both options decay to near zero. Either call and put. Your pocket full of premium. You got the premium when selling the option. If it goes to zero, you have gained the premium amount. Next chapter is hedging volatility risk. Hedging volatility risk. Even professionals hedge volatility. Here's how. Use calendar spreads. Buy long-term option. Sell short-term option. Use calendar spreads. Buy long-term option. Sell short-term option. Use long Vega positions to protect portfolios. Use VIX futures or ETFs to hedge market-wide risk. Use VIX futures or ETFs to hedge market-wide risk. For retail traders in India, hedging means avoiding naked option selling in high VIX, using spreads to limit risk, booking profits quickly after IV spikes. IV means implied volatility, booking profits quickly after implied volatility spikes. Next one is volatility in different markets. Volatility is not the same in every market. In stock market, volatility spikes around earnings, elections, budgets. Use straddles, strangles, iron condors accordingly for this kind of markets. In commodity trading, volatility influenced by global news, weather, demand and supply. It affects in the price of crude oil, gold. These two commodities prices are very volatile. Option strategies work well around inventory data releases. Then forex and currency markets. It is the price of currency market influenced by interest rate decisions and inflation reports. Options not liquid in India, but features are avoid over leveraging during major data releases. Leverage, you know about leverage. In other words, it is a limit in the Indian markets. Crypto markets. In crypto markets, inherently volatile. Weekly options available on Bitcoin and Ethereum in some platforms because these are exchange specific. Great for strangles and long Vega plays. Use stop loss carefully. Now come to common mistakes in volatility trading. Warning one is don't buy options when VIX is already high. I hope you understand. Common mistakes in volatility trading. First mistake is don't buy options when VIX is already high. Premiums are inflated. Next warning is don't sell naked options when VIX is low. No cushion for movement. One second, I repeat. Don't sell naked options when VIX is low. Another warning is don't hold straddles too long because time decay will kill your profit. Another warning is don't guess direction. This is totally wrong. Don't guess direction because and focus on expected movement, not hope. Next chapter is pro tips to trade volatility like a pro. Pro tips to trade volatility like a pro. Use India VIX daily to guide your options positioning. Learn Vega impact before placing high risk trades. Backtest how volatility behaved during similar past events. Use spreads like Strangle, Condor for safer high IV plays. Keep risk defined. No unlimited loss strategies. Book profits after the volatility event is over. Final words. Volatility is opportunity. Volatility is not chaos, it's just energy. And if you understand how to read it and trade it, you are no longer reacting to the market. You are planning ahead. VIX, Vega, and volatility based option strategies are your toolkit for uncertainty. Whether it's a crypto crash, an RBI policy decision, or a global war scare, volatility tells you where the market is tense and where the real money will move. I think these things are very helpful to you. If you have any doubts or any suggestions, please post in comment section. Once again, I am thanks to everyone. If you have any doubts, as I told, please post your doubts and suggestions in comment section. And if you have any content idea, also please post. Once again, I am thank you. My name is Sankar Srinivasan again. My sincere thanks to every traders. Thank you.